Welcome to The Explainer. Today, we're diving into a real head-scratcher. We're looking at a company that's getting rated as excellent and weak at the exact same time. I mean, how is that even possible? We're going to break down these conflicting signals and show you how to read between the lines. All right, check this out. This is the report card for Ujjivan Small Finance Bank. And right here, it gets 5 stars for excellent efficiency, says it's using its assets incredibly well. But then, look literally right next to it, just 2 stars. Weak financials. I mean, excellent and weak, which one is it? And that's the mystery we're going to solve today. We are going to peel back the layers on this company, dig into the numbers behind these crazy ratings, and figure out what's really going on under the hood. So let's start with the good stuff. Let's make the case for excellence. What numbers are actually backing up that 5-star efficiency rating?
Okay, so the people who are bullish on Ujjivan, they're looking at some really solid points. You've got a strong capital cushion, a great track record on profitability, and impressively low levels of bad loans, or what the industry calls non-performing assets. Let's dig into 2 of the most important metrics here.
First up is this number, 23.10%. That's the bank's capital adequacy ratio, or CAR for short. Now, this number isn't just good, it's incredibly high, way above what regulators require. But what does it actually mean for you or me? Think of CAR as a bank's financial shock absorber. It basically tells you how well it can handle a big, unexpected loss. And at over 23%, Ujjivan's cushion isn't just thick. We're talking about a financial fortress. This one number just screams stability and safety. Next up, return on equity, sitting at a very healthy 14.35%. This is all about efficiency. It shows how good the bank is at turning its shareholders' money into actual profit. And a number this strong is a huge reason it gets that 5-star rating.
Okay, so the bank looks stable, it looks efficient, but hold on, that's only half the story. Now we need to flip the coin and investigate the other side, the reasons for concern.
And what's wild is the bank's own report spells out some pretty big limitations. We're seeing a big drop in something called CASA. That's the cheap money banks get from current and savings accounts, and a huge, huge spike in something called provisions. This, right here, is where our detective story gets really interesting. And here's the result of all that. Profit growth is down over 43%. Whoa! After seeing those strong efficiency numbers, how is that even possible? This negative number is the central clue in our whole mystery. And here it is. This is the smoking gun. A nearly 250% jump in provisions. So what are provisions? It's basically money the bank has to set aside today because it's worried some of its loans might go bad later. By setting aside so much, they're taking a massive hit to their current profits on purpose, which directly explains that 43% drop we just saw. Now, this brings us to the stock's valuation. On the left, you can see the stock price has been all over the place. But look at the chart on the right. That's the PE ratio. It's basically a measure of market hype. And you can see it's been climbing and climbing. This creates a really dangerous disconnect. The market's expectations are going up, while the company's recent profits are going down. So we've got 2 completely conflicting stories. Is this an efficient, solid bank just hitting a temporary rough patch? Or is it a risky bet? To really decide, we have to zoom out and get some context. This profit and loss statement tells a pretty dramatic story. Just follow the net profit line with me. See that? In 2022, a massive loss of over 414 crore. But then, just 1 year later, an incredible turnaround to a huge profit. This shows you the company is resilient. So while this most recent dip is definitely a concern, it's pretty clear this bank knows how to bounce back. And what about its competition? Well, you can see Ujjivan's PE ratio is on the higher side, which backs up that expensive label we saw. But its efficiency, that ROE, is super competitive. And get this, its level of bad loans is actually lower than most of its peers. So even here, it's a mixed story. All right, we've seen the evidence, we've looked at the good, the bad, and the complicated. It's time for the final analysis. What's the verdict on the Ujjivan paradox? So here it is, the entire case on one slide. On the last, you've got all the positives, that incredible capital cushion, high efficiency, and a proven history of resilience. But on the right, you've got the red flags, falling profits thanks to that huge increase in provisions, a pricey stock, and slowing growth. So what's the verdict? The verdict is that there is no simple verdict. The truth is a complex balance of these 2 realities. And that leaves us with the final and most critical question. Will Ujjivan's proven efficiency and its strong foundation be enough to power through these really serious financial headwinds? There's no easy answer, but now you have the framework to analyze the clues for yourself. Thanks for joining this explainer.